Good evening, folks. Welcome to tonight's webinar. My name is Jeff Hooper. I'm the Chief Operating Officer here at Ackerman Group. And we just want to welcome you to tonight's call. We've got a great group of panelists tonight for the fourth. This is the third in our series right now called Selling My Veterinary Hospital. Some of you have joined us for the previous couple of webinars, and we hope that you enjoyed those. If you haven't attended those, they are on our website and recorded. You can certainly take a look at those. Tonight's topic is hiring the right advisors, and we have got some great advisors on tonight. You're going to hear a little bit about what they do for a living and why you might consider hiring anybody in those practice areas that they excel in. So as I said, this is the third in our series. The next one in 2 weeks is what you should know about corporate buyers. That's March 23rd. We're going to talk about the sale process with everything that you need to know. April 13th. And then we're going to wrap this series up with what to expect in today's market, kind of a market update based, and talk a little bit about multiples and pricing and where we think the market might be going. So anybody that's interested in selling your practice, this is the place to be tonight. It is an interactive presentation, certainly, so to hear from you. If you have for a panelist, Gary, throughout the presentation, there's a couple ways you can do that. You can just type your question into the Q&A function on your computer. You'll see a Q&A button. If you'd like to speak and ask your question yourself, just hit the little hand button that you have on the bottom portion of your screen. Or you can type your question into the chat function as well. So the panelists will see your question. Folks, everybody on the panel, if you would just let me read the questions as they come in, because the audience can't see the questions. So I'll read those before you guys get a chance to answer them. Before we dive into our presentation tonight, I just want to tell you a little bit about Ackerman Group for those of you that are not familiar with our organization. Ackerman Group has sold a little over $750 million of veterinary hospitals here in the last 3 years. That represents a little over 130 practice owners. And really just want to share something with you about kind of our model for success that's built around 3 basic principles. Number one is we try to find for our clients the very best fit. In other words, meaning the very best cultural fit for your associates and your staff. If you're considering a practice sale, that's generally the very first thing that folks are worried about, making sure that it's the sale of the practice is smooth and that your employees are happy post-sale. You want to try to find a company that integrates with your computer systems, your lab systems, maybe the same vendors you're used to using, and also that are going to practice medicine very similar to the way you have built your business. We find it's probably one of the most important factors is finding the best fit. Secondly, the second leg of the stool there, so to speak, is terms, right? Not just the terms of your purchase and sale agreement, but customized terms that could involve contingencies or earnouts, making sure that you maximize everything that you have generated and are producing in your hospital. There's these transactions are extremely complicated these days with joint venture options. A lot of companies have opportunities to roll some of your purchase price up into private equity. Obviously, there's employment agreements, benefits from the new company that have to be negotiated. They all are going to ask you for non-compete agreements. Those are also a negotiable item. And of course, your real estate. What are you going to do with your real estate? What do the terms look like? So terms are extremely important next to finding the right company for your practice. And then lastly is the price. A lot of folks start with price. And when Gary talks a little bit later about price, and there's a lot of offers on the table from corporations out there. And sometimes when you see a high price, you kind of jump and think that's amazing. But the price that's being offered is not necessarily the all that there is to contemplate when talking about price. The enterprise value is just kind of the starting point. There are lots of other earnings and value that can be built into your practice sale that can add value long term. And that was, as I mentioned earlier, joint ventures, private equity. Kind of a total return picture is really what we think is the key to getting the best price for your practice. So those three principles for the Ackerman Group have worked really well. As I mentioned, we've had a lot of success here. We're going to talk tonight about why you might hire someone like ourselves. It's something that we always say in practice sales, that if you don't hire us, please hire somebody, get some help. So I'm going to turn the program over to Gary. Gary's going to talk a little bit about just the practice side of it from a brokerage perspective, and then turn it over to some of our guest speakers.
Jeff, thank you very much, and welcome everybody onto our call. This is the third one in our series of selling your veterinary practice, as Jeff said, but we do webinars all the time for the veterinary industry, and we invite everybody to come on, from owner doctors to associates to people that work for the different companies to the veterinary advisors that we have on this call, or other veterinary advisors, because our goal is really just to get good information out there to the industry. And we learn from all the people we get onto the calls, we learn from the companies, and the main thing that we want to do is be able to impart some of that knowledge back to the veterinarians that are considering doing some exits. And so the one thing we really want is we do these webinars, and we like people attending, but they're also on our website for numerous other people to listen to, because this is such a relevant transaction to so many of you when you're looking at exiting your practice. And I know, because I used to sit in your chair for many years. I am a veterinarian. I practiced for 20 some years, had a couple of practices on my own, and I sold my practices in 2001. And since that time, we've been advising and brokering on practice sales, have done a ton of commercial real estate and other type of tax deferred transactions over the years, 1031 exchanges and other types of installment sales, was licensed as a financial advisor and securities representative for many years, and did investment planning. Actually, Brent Morse, who's on here in a little while, was my partner in doing that for a number of years. We've done, in the last 3-4 years, at least $750 million of corporate sales, and I quit counting. We were 100 plus on those, with at least 15 or 20 of the different companies that are on the market. So we're really well vested in these types of transactions, and in particular lately, with so many of the transactions having multiple facets to them. They're not just cash transactions, but they're joint ventures where you partner with the company, or they're private equity where you sell part of your practice and do roll-ups into private equity. We've done dozens and dozens of those. We probably had 30 or 40 go full cycle. So we've had a fair amount of full cycle experience on this, so we can give you some thoughts on how this might work in your situation. And this is relatively new in the industry, and so our goal here is to try and help you fit these in a manner that makes sense for you from a personal perspective. I always tell everybody that we have the holistic approach when we go and do these transactions, and mostly because of my background on doing so much of the planning and things related to it. It's not just about selling your practice. This is probably the most material financial transaction you may do in your lifetime. And so our goal is to make sure that you're getting all of the other appropriate advice as you go through these transactions. So, everything from veterinary attorneys to CPAs to, we have some of the accessory advisors on this call that are advising on real estate or financial planning or, family and estate planning, any number of things that are spinning around and ongoing that you should be paying attention to before, during, and after your practice sale. And so this is really the call that probably, if any call we do shows the holistic approach that we're taking to, this call should do that. So, the real question is here, what advisors should you be looking at? That's where we are now. We want to look and see, who are the advisors that are the really the needed advisors, and then who are the advisors that you need, but you don't know you need it. Let's put it that way. So Jeff, if you can do the next slide. The first one is, should you hire a broker, just us, an advisor for this transaction? What we see right now is there's a ton of people that are going alone. They're veterinarians. They're used to being independent. They're doing their own transactions. And I can guarantee you the counterparty at the table that you're negotiating with, that is whining and dining and wooing you to come with their company, knows more about it than you do. And so just really be careful on that. Is how do you know that you're getting fair market pricing, you're getting fair market terms? what we see so commonly now is the pricing and terms sound so good because people don't know what market is, that they tend to agree to stuff that actually isn't market. So who's calculating your EBITDA? Who's normalizing it? If you're leaving this to a company, you probably would be better served having an advocate in your side. Who's going to assist you and look out for your associates? The associates are an area of huge angst for a lot of our owners, because they wonder, how are my associates gonna take this? What do I have to do in the way of getting them to sign employment contracts? Can they participate in some type of bonus program or private equity program or things like that? So we certainly help in smoothing that process out. We do calls with the associates on a regular basis to help them understand what's going on and what their options are. Who's going to look at minimizing your taxes? What's involved with that, and integrating your transaction with your CPA with somebody that might be doing the private equity or joint venture transaction that's on a tax deferred basis, that's doing installment sales. So we help integrate with that. Who's going to integrate with your financial and estate planning attorneys and financial advisors? You'll hear from both of them in a little bit, and for them to do their jobs effectively, they need to understand exactly what you're doing on your transactions. And we see a lot of times that the selling doctor doesn't know enough to tell them exactly what's occurring, and a lot of the brokers frankly don't have the technical skills to be able to relay this in a manner to the appropriate planners that you're using with. And also, what about your real estate? We have a lot of you that own real estate. Are you getting fair value for it? What's your rents? What if you want to sell it, what should your sale price be? How do you take it to market? Who are your buyers? And so we're here today to kind of give you some ideas about the other advisors that you might be using in these transactions. And so the first thing I'll start with is the necessary advisors. These guys are a must. Okay, you're going to have a CPA to do your taxes. They're going to the critical pieces to all of this. They're going to get your profit and loss that your whole sale price is going to be based off of. We're going to create from that a normalized EBITDA in conjunction with your CPA, and this is going to generate what your sale price is, which is going to generate what your taxes are. And if you're contemplating any structural changes to the transaction via the joint ventures or the private equity or installment sales or anything, these are all ways you can defer taxes and minimize them along the way. And so your CPA is going to be integrated heavily in all of that. We're not bringing a CPA to this call. The next one is a veterinary attorney. We're not bringing a veterinary attorney to this call because these guys are so important. In this 6-part series, they each get their own call. We've already had the CPA on our one that was entitled "What the Heck is EBITDA," and the sale process planning one. The veterinary attorney is going to be coming on and talking to you all about what that process looks like. And the attorneys are running through your sale documents, your real estate leases, your equipment leases, your associate and owner employment agreements, your JV agreements, your private equity joinders. All of these are things that are material to these transactions that I guarantee you're going to understand about 10% of. And so these attorneys are just critical to getting these things done in a manner that's going to get you an effective transaction. So these are your necessary advisors. And then the next page, we've got the advisors that we'll just call them the advisors that are desired. And my question mark on that is, are they required? Okay, well, in our mind, these are absolutely parts of the transaction that you need to be addressing simultaneously or in advance or after your transaction. I mean, these are things that are going to come up that you're going to need some advice on that's not specific to your transaction. It's not the transactional piece of it, but it's hugely relevant to it. And these all integrate with each other. And so what we've brought to this call is people that we talk with and bring in to talk to our clients on a regular basis. Everybody on here has been in and talked to dozens of veterinarians in veterinary practice. So they've got huge experience in working in these areas. And so, what we want to do is bring in some of the holistic piece that we do and have you simply talk to the people that are doing this planning for 50 plus other veterinarians. These are the guys that serving your peers, and so they know what you're doing, what you're going through, what typically occurs, and they're going to talk a little bit about it. So that's really what our goal was from this webinar today. So in that vein, the first thing I'd like to do is asking, about the advisors and who needs them. And I specifically put this here for Brent so he could see it, since it was since he's the financial advisor and is going to come on first. I think this goes back to our days of doing investing and everything. And this is where you are in doing your transaction. And the cartoon was, I was spreading some risk around, and apparently it all wound up in your portfolio. Well, that's maybe not necessarily the goal. And so the question is, how do you put these transactions together to dial back the risk? And the risk here is, your tax risk, your investment risk, what you're doing from a planning perspective for your kids, what's your risk in your single tenant, real estate. All of these are risk things that may need to be addressed. So we're going to start out, we're going to bring on Brent Morse and let him introduce himself. He's a financial advisor that I've worked with for many years and was actually my partner for a number of years. And so Brent, it's all yours.
Yeah, well, thank you for the introduction, Gary. I do appreciate it. And I do apologize if I'm a little dark or seem a little tired. I've been skiing with my 10-year-old son, so he's in bed, and I'm wanted to get on this call with all of you folks. But I do appreciate being on the call, Gary, Jeff, and to Gary's point, I'm a financial planner, a portfolio manager, tax and estate planner that works with professionals like RJ or some of the other professionals that you've already spoken to in some of these other calls. And basically what, my function for all of you on the call right now, it really is twofold. One is I want to be able to help you, sort of delineate all the options that are in front of you as you move through this transaction, the sell process of your practice. There's so many things that are so unique to the transaction itself, like Gary was talking about, but there's also, I guess, the ancillary advisors, such as myself, which can tie it all together. We take specifics of what is in front of you now with your sale practice, and how does that affect the rest of your financial profile, and how's it going to affect your balance sheet, your net worth statement for the foreseeable future, and how can you minimize taxes, not just on an annual basis, but through working with someone like RJ, through estate planning and tax minimization as you pass on your wealth to a younger generation, or charities or churches or whoever it is that you want to pass your wealth down to. So what we like to do when I'm getting to know new clients is I like to establish a base plan, a financial plan that not only addresses the specific needs of your practice sale, but how do you need to think about and view your net worth over time. So far, no one of Gary's clients have we had to work out, like, how do you pay off your credit cards or make a car payment. It's much more involved and much more complex than that. It's more like, where does the liquidity come from after I quit working? What kind of JV percentage should I pursue? Is it 30% or 40% or 20%? How does that impact my long-term overall net worth profile over the years, right? We also will look at your real estate and work with other real estate professionals in the field. And how do we approach your real estate? When is the best time to sell your real estate? And then if you do sell your hospital building, how are you going to replace that income? And not only that, but how are you going to get the income to, pay your bills in a tax efficient manner through income or capital gains or cash? All those issues are addressed, which are specific to the practice sale, which is wildly important. We all know that this is a very, very big event in all your lives, and working as a vet for the most part has been your life and how you've provided for your family. So how are you going to do that moving forward? Not just by paying bills, but reducing taxes, reducing the state tax, on a lot of different areas. So the financial planning that's involved, the type of planning that we do, it addresses a lot of those issues: insurance, liquidity. How do you look at risk of the asset base that you have now, which was once 90% of your net worth was wrapped up in your practice, and now it's become a monetized asset. So how do you diversify risk with this new asset base, this new inventory that you have? So there's a lot of credit and risk modeling, not just in the markets themselves, but in your lifestyle. We talk about a lot of different issues in the financial plan. I think a real good example of one of the outcomes that may not come up for every single person on the call, but depending on where you are and how old you are and how many kids you have and all that, we all have different needs at different ages and different stages in our life. But Gary, one of your clients, we just went through a financial plan review with her last week, and we were talking about retirement and obligations and things like that, and how she wanted to retire. And she had described a certain environment that she wanted to live in during her retirement, and not wanting to be a burden. And so we figured out that to get into a retirement village that she wanted to be in, she had no idea that she should have been on the waiting list about 10 or 15 years ago. So, and she had no idea where to start. So after going through all the different variations of the practice sale and how much money she was going to have or not have, the most important thing for her right now today was making sure we got her on the list, and she got on the waiting list so she could be in a retirement environment that she wanted. So it's what I do is not just financial. It's driven by financial decisions, but the estate planning, the financial planning that we like to do for clients is much more personal and much more involved than just saying, hey, you need to make 7% in your portfolio. You're going to get this much money, so you'll be fine. Because there's much more to being fine than how much money you have in your bank account. Don't get me wrong, it solves a lot of problems and we don't mind having it there, but that's not all we talk about at Morse Capital Partners. And I feel very blessed, and I'm grateful that I had the experience that I had. I worked at Ernst & Young. I ran their wealth advisory practice in the Mid-Atlantic for several years, working with all kinds of different clients and folks just like you, who have worked really, really hard, and now you're sort of reaping the benefits of all the hard work that you put in over a lifetime. So, as far as working with Gary's clients and being very comfortable with veterinarians, and we've worked together, Gary, with well over 75 plus veterinarians, and they're ongoing clients of Morse Capital Partners, and a lot of the same issues that I've worked through with them, I know that you will have the same exact profile, the same format as far as things that need to be addressed. What we talk about with your particular situation will be different. It's different for each person because each person has a different set of circumstances. But those are the types of financial profiles that we put together, and we're trying to address a lot of specific issues as it pertains to the sale, what's immediately in front of you. But the financial plan you should be able to use over your lifetime to make, you'll be able to understand the economic impact of all the financial decisions that you'll be making between now and for a very, very long time to come. So it's very comprehensive. To Jeff's point, we cover a lot of topics. We have a deep set of knowledge in a lot of different areas. And when we don't have specific solutions for you, we work with RJ Wheaton, we work with Gary Ackerman, we work with Gabe, and folks like them to make sure we're bringing to you a full set of, services that can answer all these questions for you. And the financial plan really is the linchpin for all those things. So, Gary or Jeff, is there anything specific that you want
Hey,
me
Brent,
to?
I have a quick thing. Can you take 60 seconds and just describe what we used to do all the time? And I know you still do it fairly commonly when I send in clients that are, this is a webinar on selling your practice. So at the time of a sale, some of the what if scenarios and things like that we would go over related to how they might structure their sales at different levels of equity or JVs or things along that line. Because I know that's been helpful for a number of the clients to
Oh,
see
yeah.
really what the other side looked like,
No, that's a great point. That's a great point. So one of the biggest questions for all of you is, okay, they're giving me all these options. I can do a JV. I can take stock in the company. I can go into the private equity roll up. There's all kinds of different ways that are trying to compensate you for selling your practice. So in the case of a JV, like how much do you sell the potential buyer? Do you sell them 51% and you keep 49? Do you sell them 80% and you keep 20, and anything in between, right? So what we do is when we put together the financial plan, we're putting together a financial plan for you in the exact current state that we know with certainty where you are. Meaning, we in the base plan that we put together, we don't even show you anything about whether you've sold or not sold the practice. We have a base plan that you can use. You can understand exactly where you are if you sell or not sell, right? Because that is what you haven't sold anything yet. So we're showing you exactly what you have today. And then we will run different scenarios of if you sell your veterinary practice today and you sell 80% to the buyer and you keep 20%, well, what's the long-term impact of that decision? How much more money or less money do you have at the end of the day if you sell 80% or 20% of your practice? Now, the value in going through that exercise is twofold. One is the real simple economic impact, which is, do I have more money or less money? I would argue that that's not what's most important necessarily. And I've had several clients that have said, you know what? I was thinking about just selling them 51 and I'll keep 49. But after going through this process with you, Brent, I can sell 80% to them now, take a little more cash now, keep a 20% JV. Maybe it's a little less money at the end of the day than if I would have sold them less, but I have enough with all the other assets that I have and the sale practice to where, maybe I can take a little bit less responsibility in the joint venture by keeping a smaller ownership percentage because, the difference is between 15 and $20 million. $5 million is a lot of money. That's a big difference. But does that mean a lot to you and your family when you can maybe spend more time with them, or a number of different things that may be important to you? So the JV percentage decision is something that we like to focus on. Whether you take an equity roll up or put it into a private equity slug with different multiples attached to them, we can put together different scenarios for you that say certain percentage JV, a certain percentage of private equity, certain percentage of preferred stock. We'll put all those things together for you, and we'll be able to demonstrate to you very definitively what are the differences in your net worth statement and the growth over time by doing it one way or the other. And we'll weave into that story, what is maybe most important of all the different outcomes. There's also real estate, Gary.
Right,
I do an awful lot of real estate analysis. So, and that's a really big piece because typically sometimes the rental income alone from your hospital building can satisfy a lot of your monthly uh, financial responsibilities. So it becomes very important to understand, like, well, what if I don't want that headache of owning the building, even though it's a triple net lease? Or, what if I want to diversify my real estate holdings from just one hospital practice to 3, 5, 8 different properties? And is it smart to diversify? Maybe it is, maybe it isn't. But how do I replace that exact same amount of income? So we'll run different scenarios for you that says, uh, here's the benefits of diversification with this kind of income replacement. So that is definitely one of the bigger um, questions that we look at when we run these financial plans.
Brett, thanks a lot. And that gives us a little bit of an idea as to what's going on there. And we'll be taking some questions. We've had some questions come in a little bit, but I'm going to move on for just a quick one to RJ and how you integrate with the financial planning and the estate planning and the family planning. And, we've worked together on a number of different clients, and it's been enlightening for me along the way. So I'll let you shed some light on it to everybody else.
Sure. Yeah. Every one of them has been different, haven't they? There are always similarities, but they're all bringing their unique characteristics to the table, to be sure. I guess just getting right into, and Jeff, if I could bother you just to switch over to my first slide, and I will endeavor to stick to my bullet points as best I'm able, but I'll beg for forgiveness in advance if I tend to deviate from what I've intended to be a script, but we all know what happens with intention sometimes. We do the legal side of estate and gift tax planning. So in that role, we're frequently working with financial advisors to get to the bottom of trying to mitigate a few things. First of all, estate tax consequences at your death. Second of all, what we're doing a lot of times with the use of trusts is also looking to avoid a costly, a time-consuming probate in whatever jurisdiction or jurisdictions you live and or own property. And then also it's the goal of looking at everything and determining what the best way is to plan for your family. That's mostly on the estate side. On the gift side, we're looking at how we're best able to make lifetime transfers to beneficiaries while you're alive. And what's the best way to do that? Is it a gift of cash? Is it a gift of marketable securities? Or is it what I prefer to do, because we get a lot more traction, we get a lot more bang for our buck, is gifting utilizing entity interests, where we're able to avail ourselves of certain discount factors that turn what is the annual $15,000 a year gift tax exclusion into a number that's maybe 50% bigger than that. Because of the society in which we live, we always keep a keen eye on asset protection as well. Owing to some perhaps bad actors in my profession, we do live in a litigious society. People of means often find themselves with potentially a target on their back. So we like to build into agreements, to the extent we're able, anything that would render you judgment proof or make you an unappealing candidate to even bring that action in the first place. The individuals who we do it for, I mean, it's funny, I was looking at everything into totality, and I went into our document system and I started to count up the veterinarians that we've worked with. Brent said 75 plus. I give you credit, you counted farther down your list than I did. I stopped at 50 and figured 50 plus would suffice. I think we're probably closer to that 75 or 100 number now, as it has been a few years. Aside from, and I will say on the veterinarian side, many of those are ongoing engagements where we're in frequent communication with the client because of what they have going on. In some instances, I'm serving as trustee where we need a disinterested party to serve as trustee, or just by nature of what Brent has put together on the financial side and what they may have going on the personal and the family side. Our continued involvement behooves everyone. Looking aside from veterinarians, gosh, the vast majority of my clients are closely held business owners. That's where in many cases, if not most cases, they have accumulated their wealth. They are real estate developers, authors, athletes, musicians, pro sports franchise owners, Fortune 500 CEOs, and I guess depending on how good somebody's divorce lawyer may be, perhaps the former spouse of any of the foregoing individuals. That just kind of gives you an idea of the kind of people that we're working with. I think the 5 million to 3 billion number is pretty accurate. That's what we've got in terms of present engagements and what I've done over the course of my career. The 3 billion I know is correct because I obviously know that individual quite well. But we really run the gamut in who we're representing. How we do it, gosh, Gary and I have done this dozens of times, mostly through email, even before that kind of communication became required. Most of the time, I'll say to folks, look, if you've done something, let me just take a look at it. If we don't have to reinvent the wheel, great. If we look at it and we determine that what you've got in place is as good today as it was 5, 10, 20 years ago, that's terrific. That makes everybody happy. What we find more often than not is folks in y'all's position have spent, almost all of your bandwidth over the last however many years, decades, growing the business. And maybe you've got a will that you put in place, 20 years ago, 25 years ago, when kids entered the picture, because your impetus really was to most of the time provide for a guardian. And you wake up one day and realize you've never revisited the thing. So I guess what we like to do is just see what's there. Sometimes there's something we can work with, sometimes there isn't. If there's not, then it really gets into digging down into what your priorities are. How is it best to provide for your family? Most of my clients are looking at the totality of the circumstances and saying, I'm a little concerned what would happen if I just handed each one of my kids, pick the number, 2, 3, 5, 10, $20 million. And what Gary and Brent have heard me say way too many times is oftentimes our concern is that you give the child those assets, and the very best thing that's going to happen is they're going to lose it all. The very worst thing that's going to happen is they're going to lose it all, and they're going to pick up a lot of bad actors and a lot of bad habits along the way. So it's looking at, does it make sense, given your family situation, to provide that assets going to children are instead held in trust for the duration of their lives. There are myriad benefits that go along with that I don't want to get too into the weeds in this conversation, because we're trying to keep it general, but those are kind of the determinations that we're looking at in terms of what you want to do for your family. Frequently with this kind of event, I think Gary is spot on. For most of y'all, this is perhaps going to be the most significant financial transaction in which you ever engage. A lot of times at this point, you realize that you do have the means to evidence some kind of philanthropic intent, be it church, which Brent alluded to, or alma mater, or charities that you've chosen to support during the course of your lifetime. And do you want to do that to a greater extent? The question then becomes, how do you want to do that? What is the best way to do it? Is it through the use of a private foundation or charitable trusts? I tend to like those. It's what I call the doing well by doing good program. Oftentimes there are significant tax advantages that we can avail ourselves of when we're looking to evince philanthropic intent. Sorry, Jeff, I think I'm doing pretty good here. Once we've got documents in place, that's usually where I really begin working with other advisors in terms of how we're doing retitling, what those trusts are going to look like, what we're going to fund them with. And that's also where other advisors come in, such as CPA. Perhaps you've got somebody on the insurance side. Some clients where we're talking about multi-practices, or in other disciplines, perhaps they have an inside CFO. And oftentimes that person is an excellent resource for me. And I don't want to speak for Brent, but I think for him also, in determining what we have and where we want it to go and how we want it to be titled. The other thing that I wanted to get into is, and I think, Jeff, it might be on another page where I talk about impact. This really is, you know, so many times I've had these initial conversations with vets who are going through this process, and they speak to, this is probably one of the most impactful things that's going to happen to me and my family. And we always want to bear that in mind. I think that's more often than not my driving force in all of this is keeping in mind the impact that it does have on family. Asset protection, again, we do look to that heavily. Like I said, once these transactions are completed, you do find yourself perhaps in a different situation than you were the day before. And we want to make sure that you're protected for that where we own real estate, we do have it in a proper entity so that we have liability protection. And again, just looking to what we're going to do for the next generation and how we're going to do it. Many of y'all, and this is something that we're frequently talking about with clients, many of y'all will have the opportunity for truly generational wealth if it's handled the right way. And if people avail themselves of good advice and good advisors. And that's probably one of the big things is clients coming to realize, not only do I have the opportunity here if I do this right, to truly make things easier and provide for my children much more than I perhaps ever thought I'd be able to, but impact their children perhaps even farther down the road. That's quick overview. Gary, did you want to?
I just have a comment, RJ, because we've worked together on dozens and dozens of clients, of mutual clients. And what's interesting is if we do our job really well and we create significant value for our clients in the practice transaction, how few of them have done this fully and how much more necessary it is after the transaction closes.
Yeah, and let me piggyback on what you stated at the very outset of your comments. And I think Brent and Gabe would probably say the same thing. If you don't work with me, that's fine, but work with somebody. And I would say begin that sooner than later. The one thing that I find is if I have the benefit of, there is no substitute for the benefit of time. If we have time pre-transaction to begin to look at things, that's where we really, really can get into some good stuff on the tax mitigation side. Gary, Brent, you and I have both seen this. You take that, yeah, I know why you're laughing. You take that element of time away and our hands are really tied in terms of what we're going to be able to do.
RJ, thanks very much. And I'm sure we may get a question or two, but we appreciate your insight here and we'll get out contact information for everybody. I'm going to move on to the real estate evaluation portion, and Gabe Simpson here is from Sands Investment Group. As I said, these are all advisors that we work with very regularly on practice transactions at different stages for different people. Just depends a little bit on it. So Gabe, I'll let you talk a little bit about yourself and what your company does and how we utilize you on the different transactions on different mutual clients and things like that. So feel free.
Hey, Gary, thanks so much. I appreciate being here. And I think RJ, you and Jeff really hit the nail on the head with finding somebody that can help you in all facets. You know, real estate is just a small piece of this whole aspect. You know, selling the practice is first and foremost, but how does that set up your real estate on the back end? And those are all things that we try and really dive into. You know, we've worked with Ackerman Group in the past to really set up the lease terms. Those are another thing that Jeff brought up earlier, were the terms of how it can really maximize value. And in the past, we had worked with veterinarians, and to back up a bit, I work with Sands Investment Group. We are a commercial brokerage firm focusing on primarily single tenant holdings there. And our team specifically focuses on veterinary real estate holdings. So I'd say 95% of my clients are veterinarians themselves. For the most part, real estate is not their forte. We understand that. So we try to educate them as much as possible in the forefront, so they can make the best decision moving forward. So putting all the chips on the table, allow them to view it and make the decision themselves. So working with Ackerman Group, we really found synergies in terms of how to, like I mentioned, maximize that value of the real estate on the back end. So coming together, having that meeting of the mind with the market rents, showing comparables and things of that nature. So what we're really looking at is going to be property value on the backside. So like I said, our goal is to provide you with the most information up front, and so that you understand that the end result of your property value once a new lease is signed. And as soon as that lease is signed or that practice is sold, your real estate is going to probably be the most valuable that it will be for the next, say, 10 years. What our team likes to do is provide the property owner, typically a veterinarian that has sold their practice at one point or another, or is in the act of doing so, is providing complimentary evaluations, where we can really provide you in-depth analysis of some of the local markets. We want to show you those comps. We want to show you those vets or local properties that have recently sold, so that you have an idea of the value of your real estate. And that's something that we track at Sands Group. We take a look, we keep spreadsheets of every vet property that comes on the market, that's on market, off market, that's sold, that's gone non-contingent, things of that nature. So if you have any questions on what affects the value of the real estate, those are things that we can dive into and really show you up front. So having somebody like Ackerman Group is such a positive thing. And that's where, like I said, with the synergies, where we've come together to be in the forefront, to have those pieces set up, those terms set up ahead of time, so that really a twofold approach for you. If you want to be a landlord and collect those rent checks, like Brent mentioned earlier, and that's sustainable for you, that's outstanding, because Gary and the Ackerman Group has put in the terms needed for you to have the least amount of landlord responsibilities, least amount of money coming out of your pocket, and the most coming in. On the forefront of that, the other prong, if you will, on the approach, is people buying these are going to have the same outlook on it. They want to look for those minimal landlord responsibilities. They want to look for the long-term leases that, like I said, Gary's going to be negotiating for you on your behalf. So we've found a huge, tremendous amount of value from this happening with Ackerman Group, with Brent, with Jeff as well. And at some point, I believe we actually use the same, Gary, I think we use the same terms here: knowledge is power. And that really sets precedence here. At some point during this process of selling your practice, you're going to be approached to sell your real estate. Somebody's going to, lob in an offer, we call it lobbying in. But the one thing we want you to realize is that these offers that are going to come in, may not be the best price point that you could get on market. So many of these buying groups are capitalistic in nature. Some of these REITs come in, throw in an offer, and they don't correlate to the market value. And if for some reason you're not educated as to what your property's worth, if you haven't had these evaluations done up front, then sometimes you're jumping into that hoop and taking some of those offers that are initially brought to you. So the SIG advantage, we call it, we want to put it on market. We want to attract the most buyers, leverage those offers. And right now, I can tell you that through COVID, through the pandemics, with the market in general, say over the last 2 years or so, we've seen a ton of real estate go from really big box, people moving out of big box, whether that be investors, the real estate investment trusts, moving out of those big box retailers and moving into other areas due to, call it the Amazon effect, if you will. Since COVID hit, it's really been a litmus test, as my partner likes to say, of what survived. And what we've seen come out the back end of it is medical properties. So to take a step back, medical, whether it be your dialysis, your urgent cares, your surgery centers, veterinary properties have really taken a big jump in value. So that's one thing to take a look at, just due to the fact that They are pandemic proof for the most part, and that's always a great thing to have in your pocket. So the buyer pool has grown exponentially, where we really are able to leverage a lot of those offers. But it really starts with that lease that gets in place and the sale of your practice. So my team here at Sands, we want to be here to answer any questions that you may have. There's always going to be questions when it comes to your property, your real estate value, what's affecting it. And at Sands Group, myself, my team, who's completely veterinary oriented, we want to be able to have that conversation with you and be able to answer any questions you might have. And Gary, I know there's probably a few things I might have missed in there, but just a 10,000 foot view approach. I, just want to be there as an asset for you guys.
No, that's really good. We're gonna try something new here. We're gonna see if we can click on your link to show them the sample of the
Okay.
report that they get. That I'm not
Sure.
if we can slide it over to the screen or not. We're gonna find out in a minute.
Yeah. Give it a shot.
Yep.
It's trying to load, so assuming it loads, we'll be good.
Okay.
Close some of the windows.
And to set the precedent for this is a evaluation that I mentioned, complimentary evaluations that we offer to show market value for a client that Ackerman Group had at one point, and we worked with as well. This was a pathway, the Horseshoe Lake Animal Hospital that we did in Collinsville, Illinois for the Halls. And we actually, Dr. Hall, we just sold this one in December actually for a great cap rate and a great price. And as you see here, it's got some general information, some fluff, if you will. What we like to do. Oh, sorry, go ahead.
What's interesting. What's interesting for a lot of the clients here is that they get info on what other practices have sold. They can see what local rents are too. And this is the kind of report we use when we're trying to help set up their transaction and things like that. So we can get rent comps, but we can also simultaneously be talking to them about the value that the lease, that this corporate lease that we're getting as part of the transaction creates for them. So
sure, absolutely. And if you continue scrolling, Jeff, just to highlight a couple more points on this one, just of everything that we take a look at. And again, it is a bit high level, but it's worth taking a look at. Keep scrolling if you wouldn't mind. This page will work here. So these are, tenant profiles that we take a look at. We're looking at market rent in the area. So we want to find that healthy market rent that'll be justified that Dr. Ackerman can work with as well. And then we're also taking a look at everything on the left-hand side there. What are, everything that goes into effect of the value of the real estate, whether that be the tenant responsibilities for certain things or landlord years on the term, the annual escalations. Those are all things that we consider. And the next page down will just be some of the sale comps and the comps that are on market, just to show you where they're trading. Here's where your stacks up to these, and this is why we believe it will trade in this area. So it's not why we think it will, it's why the market's dictating that. So.
yeah. So this is Zillow for your veterinary hospital.
That's right.
Okay, Jeff, thanks.
Thank you, Jeff.
There we go. So the last thing I'm going to give a quick discussion on here was just a little bit of the tax mitigation. This is kind of a mitigation and deferral is kind of a hybrid of a lot of different things. Your CPA is working on it. Your trust and estates people are working on it. Your financial planner is working on it. Your real estate person may be working on it. But I kind of, in a lot of circumstances, act as the conductor. So what you have to realize is there's numerous bites at the apple in these transactions. That's the really good thing about it. So when you're doing a joint venture or a private equity type of transaction, there's no tax due, or there shouldn't be on the retained portion of the joint venture or the contribution to the private equity parent company. You can do a lot of things in structuring your transaction, which really goes to the legal and a lot of perspectives about how you might lower tax in certain circumstances. We might allocate some to personal goodwill. We might work with your CPA to review the taxes, because we have a lot of them that, because of the joint venture or private equity or the type of investment that it is, don't understand the taxation of the transaction. They understand how to do profit and loss, but we see a lot of mistakes on transactional accounting work. Allocations are important, where how much is allocated to goodwill versus furniture, fixtures, and equipment, or inventory, which are taxed at ordinary income instead of capital gains? Are there other installment sale tax deferred structures that you can put in place, and are they appealing? Who's your creditor? 1031 exchange planning, as both I think Brent and Gabe were both talking about things along that line. Those are all tax deferred structures that we routinely see on these types of sales. Now, they obviously might not all be present in any individual sale, but 2 or 3 of them we've absolutely done in the same sale. So this is just be aware that you need somebody that's got some cognizance of these, or they're just plain not going to get planned. And so that's all part of the holistic piece of the transaction that we were talking about previously, because when we come in, we tend to serve as the conductor and make recommendations to you that you should seek opinions and consultations with all of these people. It's just not something we're going to do ourselves, but we know enough about it to know when you're in a situation that it would be relevant. So just kind of wanted to give everybody a little bit of an overview of the different types of advice that would be appropriate coming in. Jeff, do we have some questions?
Yep, we do have a couple questions here. So first one comes in about I guess maybe this is for you, Gabe. Are real estate appraisals the same as a property valuation? Appraisals and valuations differ, and certainly counties look at property values differently. So maybe just touch on that.
Sure. Yeah, we're not going to, the tax appraised value is going to be completely different. The way we look at it is an income, towards an income approach. So it really depends on your net operating income. What are you receiving in rent? Those are things that we look at. Anything that you're paying for as a landlord is going to be deducted from that net operating income. But for the overall approach for a lot of these investors, the real estate investment trusts, the local buyers, the guys in 1031 exchanges, it's going to be the income approach. How much money am I going to make on a yearly basis, and for how many years on that lease? Those are really going to be the big pieces of it, as well as who's the tenant, and that plays a big part as well, just in terms of the credit backing it and the risk involved.
Got it. Gabe, another quick question just on real estate. Can you just explain triple net for the audience? Are all leases triple net today, and how do you define triple net?
Absolutely. So when we look at triple net leases, we're looking at the tenant paying for your taxes, your insurance, your utilities, and even the roof and structure becomes one of the nets as well. So those are all pieces of them that we look at, and all leases are going to be different. Some will be double net, where there is, the tenant's paying the taxes and paying the taxes, or they're paying the roof and structure. Again, that's where Ackerman Group is so good at laying out those terms, because an absolute net lease where there is no landlord responsibilities is going to bring larger value on the property than, say, a double net lease. So they vary completely, but they're all negotiable terms.
Great, makes good sense. Gara, maybe you answer these and get some feedback here. What is NOI?
So Gabe was just referencing this. This is NOI is net operating income, and I hate to burst everybody's bubble here or anything like that, but the reality is this is your practice. But at the time you're selling your practice or your building, it's your practice investment, and it's all related to net operating income. Your everything you're going to get paid is on your real estate or your practice is related to your net operating income. That's basically the same thing as your EBITDA. That's what we talked about earlier. But the reality is, at the time of a sale, this is an investment. It is absolutely an investment for your buyer. Okay, so just realize at some point in time it's going to become your investment also. And the net operating income is one of the 2 financial calculations that drive what your pricing is, and the other is really what multiple you're being paid on it. So we started out this series, our second program that we did 2 weeks ago was called What the Heck is EBITDA, which could be what the heck is NOI, same thing. And we spent a whole program just going over that because it's so important.
Yeah, we've got this next question could be a program on its own, so I'm going to let you just touch on it briefly. But what are the advantages of a joint venture and private equity? Maybe Brent could chime in too, really, when you start working with clients trying to make that decision. Do they want to continue to own part of their practice, or do they want to roll money into the private equity? Gary, you want to just explain them first, and then maybe Brent can chime in.
Yeah, I'll start and then I can let Brent chime in a little bit. It's kind of a continuum. When we start working with sellers that really don't have a lot of expertise on the market, a lot of them are thinking that they'll do a cash sale, which is just get paid 100% cash for the transaction. Unfortunately, in today's higher multiples, the companies are trying to mitigate their risk to some degree, and one of the ways they do that is letting you keep some skin in the game, and they do that by either having you keep a piece of your existing practice, so you sell 70% and retain 30, and that's a joint venture. You now have a partner in the practice, and you're each getting your own distributions, and you're sharing it, and at some point in time, you have a right to sell your remaining interest to that majority partner, and the terms of the distributions and the terms of that sale, that future sale, are highly subject to negotiation. Conversely, you might also choose to sell 100% of your practice, but in return, instead of getting 100% cash, you might get 70% cash and 30% shares in the parent company, in the company that owns all the practices. And this tends to be a little bit more of an investment. You're there in a company that's buying additional practices, that's trying to grow their practices, grow each practices in the group, and grow the number of practices in the group, and then and by doing so, increase the value of the company. And you're literally a shareholder along with many other veterinarians and the people who are running the company and the private equity firm behind it. You're all typically shareholders in the company equity. And this has been a little bit more return for most of our clients, just because it's also got a little bit more risk. It's also a little bit less under your personal control. So what we see is people early in the process tend to be a little more joint venture oriented because they're simply keeping a percentage of something they already own. And as they get a little bit more education in the process, they understand the investment thesis, they get some comfort with the company, a little familiarity, they become a little more favored towards private equity because of the higher returns. And so we typically see joint venture sellers maybe keep more. They might keep 40 to 49%, whereas private equity rollovers might be 10 to 30 or 40%, somewhere, usually a little bit lower amount. But either one of them is typically a multi-year investment with you partner in one way or another with the company. And we've got a lot of data on statistically how well these things have done. Our clients have done wonderful on these things. And I'm pragmatic. My general sentiment is if you're an owner and you're a material producer at the practice, you're going to have to sign a 2 or 3 year employment agreement to sell your practice. And if you're going to have to be there serving as a managing veterinarian and still a producing veterinarian to some degree, why not continue to participate in the profits and the growth in the business or the company? You're going to be there anyway. And so we kind of have a pragmatic approach, and it's certainly dropped to the bottom line. So, Brent?
Gary, I think that was very well said. I mean, maybe, one finer distinction would be, a lot of it does depend on your energy and your motivations for wanting to be very much involved in your own practice after this first sale occurs. To Gary's point, right now, today, where the industry is right now, I think monetarily, you could probably make more money on a private equity piece than you could by maintaining a higher proportion of a JV percentage. But on the flip side, which is something I talk with all my clients about, and vets in particular, is, risk starts to creep into the market and private equity goes away, you're going to very much want to be a JV percentage partnership than owning that private equity. So, those are it's sort of a risk reward profile question versus how much money you can make. But, those are some of the things we talk about.
So it's interesting, I track the private equity indexes and loan rates and things along that line, and nobody wanted to be a private equity investor last April and May.
No doubt.
and a lot of other investments didn't necessarily do well either, but the private equity guys, the lending, clammed up, and people were kind of nervous as to what was going to happen, and transactions slowed down. A lot of stuff happened, slowed down then, and then thankfully veterinary medicine rose to be one of the creams of the crop. They're certainly in most of the private equity portfolios top 10% of the performers in there. So that's why people are still flocking here.
Did you know, hey Gary, did you know that the PET, the ETF, the ETFs that you can buy on the open market, that like the mutual, like the veterinary mutual fund was is one of the top performing ETFs of 2020, right? That just sort of demonstrates that's a support for how popular the veterinary industry is right now, and that would imply that private equity for the moment is very much a very sought after investment right now.
Yep.
Hey, Gary, a really good follow-up question here on private equity. Is there accurate information on the parent companies, such as share book value or PE ratio? If you're considering investing in private equity, how do you know what you're investing in?
So the key question to that is there accurate public information on the parent company share book value and PE ratio? There's tons of information, and these guys have a lot of information behind the scenes on it. And you get some of it if you're a shareholder in there and things along that line. We ask when we're talking to companies where we've got people that are investing in the private equity, we want to take a look under the hood and look at the financial statements. They've got the balance sheet, the profit and loss for those companies. We're looking to see at what multiple of earnings that they're selling for. We're looking to see, or that they're valuing themselves. We're looking to see what their corporate overhead is, because ultimately their earnings as a company is going to be their earnings as at a hospital level minus their corporate overhead. So that gets to company level earnings. And so, we look at all of that. We look at the growth. We look at the growth on a same store basis. We look on a growth just by additional acquisitions. These are all things that are relevant to determining the viability of the veterinary investment you might be considering joining. And, we see some companies that we don't think they're going to sell in 10 years. And we have other companies that we think they're probably going to sell and have what's called a recapitalization event, and it's usually a pretty substantial increase in value sometime in the next 6 to 12 months. So we're tracking not only how practices are doing financially and where they might be on their ownership and sales cycle, we're absolutely tracking the companies and how they're doing, and more than that, this may be similar to what Gabe was talking about in the veterinary industry being well thought of, even more so now after the pandemic. We are absolutely looking at where the companies are in their cycles, because as they get closer to a sale, they're more incentivized to either pay a little more or be a little more flexible in your terms, or do different things that you can negotiate, because they know that they're going to be doing an exit in a relatively near future. And so some of the things that you might not get earlier in their pipeline or timeline, you can get later. This is part of what we do. We try and track that and understand. And so our goal when we're doing somebody that's looking at a private equity investment is not only the right price and the right terms and the right fit. You want a company that's the right fit, but the right investment. You want to match all that up, and that's interesting, because occasionally we see circumstances where the sun, the moon, and the stars line up, and it really works good.
Thanks, Gary. Maybe just one comment. We're getting a little bit over our time here, but I just had a thought that it might be good, since I know selling your practice can be overwhelming just in itself, but now we're talking about all of these other fields that need to be touched on in terms of advisors. When would you recommend that folks start looking for financial advice, start looking for tax advice, looking for estate planning, looking for valuation of the real estate? Obviously, they know the CPAs and the attorneys are already engaged, but when does all of this come into play?
My comment is I'm hopeful that a lot of them have been engaged many years previously, but a great example is RJ, and he's talking about stuff, is if you did stuff many years previously, you're having a lifetime change here of things like that. So get a checkup. This is what's happening. Brent's talking about this is what is happening with veterinarians right at this time. And what we see for literally for all three of these other people that are on this call is what's happening at the time of your practice sale will stimulate your need for better advice in all of their three areas. That's what we see. And as you're a business owner, you kind of get stuck in doing the same thing that you've done for the last 10 years. And your situation's changing, absolutely changing. And so your needs related to that are going to change. So listen to webinars like this so you know what you need to be doing.
Can I just add one thing real quick to that, Gary, if you don't mind?
Sure.
What I find myself saying, all the time to folks in these positions is, your current advisors, oftentimes I find it's more on the CPA side, may be very good, but oftentimes I find myself saying to somebody, you've got a guy who you spoke with once a year, and basically their job was to complete your 1040 and put numbers in boxes. And you may have reached a level of sophistication right now where you need to bring more firepower to the table. And I would say to people, again, I'll go back to what you just said regarding time and what I said during my comments regarding time. There is no substitute for it. You give us the benefit of that, and it could truly open up a whole world of possibilities that we wouldn't otherwise have available to us. So in terms of when is the best time to engage, to me, it would be yesterday. The next best time is today.
That's great, RJ. Thank you.
What was the thing that Gabe had there on his thing? Knowledge is power. This is it, guys.
Any comments on sort of when to engage?
For us, it's up front. We're going through the motions and doing, the wheels are turning. We're speaking with clients that are your clients and giving them just baselines. And like I mentioned, we're working on those market rents for those healthy, maximizing the potential of both the property and the practice. So as RJ said, no time better than the present. And we wholeheartedly agree that getting with a CPA that you trust, because we can provide those 1031 exchanges and the cash flow analysis, but it's always nice to have a CPA that can back up that as well. So I wholeheartedly agree with that.
Hey, Gabe, one other comment related to the real estate and you.
Okay.
We see all these people that their practice is their baby. They've put it together for so many years. It's part of their persona. And what we always encourage them is to get some professional help related to the real estate, because the day they sell, it's now their commercial property. It is not their veterinary hospital. It is not their baby. It's not their business. It's their commercial real estate property. They need to treat it that way.
Right. No, I agree. And it just comes down to, does it make sense for you to cut ties with it? And a lot of vets that I work with, stay on as the managing director, if you will, but a lot of them want to cut ties wholeheartedly. Once they sell the practice, the real estate is the next thing to go as well. So it just depends on your level of involvement, where you want to be.
Brent, thoughts? When to engage?
I can't, we've all said the same thing. I agree with all of y'all. It just, the earlier we can get involved, or someone that has knowledge of your situation and how to prepare you for that and help you plan for that, the better. I mean, RJ, you and I both know we could go into very specific examples that would just confuse everybody at this point. It's been a good call, but long call, but the sooner the better.
That's great. Thanks, guys. We really appreciate your time tonight. Just to wrap things up, guys, just a reminder not to do this alone. If you don't get advice from us, please get it from somebody. Don't do this by yourself. Don't try this at home, as they say. Ask questions, get engaged. That's the key. We're all about knowledge and education. Our website has a wealth of information on it. We do have a no obligation, no cost evaluation of your practice that we do. You can go to our website and read about that. Just get us some information. We'll collect some data and do evaluation. It's, it works for us as well as for you. It is a way for us to figure out what your earnings might be and what a practice like yours might sell for. It's the best place to start, and we can sort of pre-qualify you and let you know what the market might pay for your practice. As I mentioned, we've got a learning resource center on our website. It's available, and there's a ton of information in there on all of these topics. So we really appreciate you joining and staying with us tonight. It was a long call. The next one is what you should know about corporate buyers on March 23rd. You can go to our website and sign up for our next session. So RJ, Gabe, and Brent, thank you so much for joining us. Really appreciate your time tonight. Everybody have a great evening.
Thank you.
See you, Jeff. See you, Gary.
Thanks to y'all.
See you, RJ.
Appreciate it.
Bye, Gabe.
See you, Brent. Good to see you.